Blockchains are one of the most important developing technologies in recent years, and many believe they will play a significant part in determining how our society develops in the future. The blockchain ecosystem has grown significantly since the launch of Bitcoin in 2009, the first well-known blockchain system linked to a cryptocurrency. This expansion has been fueled by advances in both concept and algorithm, as well as the emergence of numerous additional cryptocoins. So in this video we will talk about modeling innovation in the cryptocurrency ecosystem. Before we continue, subscribe to our channel. The majority of newly created blockchains and the cryptocoins that go with them arise from existing projects forking. Here, we demonstrate that a sub-linear power law, Heaps law, of the overall capitalization of the cryptocurrency market may adequately explain the emergence of new cryptocoins. In addition, we suggest a model that accurately captures the development of the Bitcoin ecosystem. According to our model, each cryptocurrency results in the development of roughly 1.58 new cryptocoins on average, which is supported by an examination of the historical forking tree for Bitcoin. The blockchain has made significant technological strides in the previous 10 years, and many believe that it will have a significant impact on society. A blockchain is a public, decentralized ledger that is most famous for being used to record cryptocurrency, or crypto, transactions. Cryptocurrencies are digital assets that may be used as a medium of exchange without the need for a central bank. The earliest and unquestionably most well-known cryptocurrency is Bitcoin. It was first introduced in 2008 by Satoshi Nakamoto. Satoshi Nakamoto is a pseudonym, and it is unclear if it refers to a single individual or a group of individuals. Reached a market valuation of 1,000 billion euros in April 2021, and is now surging past 500 billion euros. Not only has Bitcoin's value increased significantly as a result of Satoshi Nakamoto's original concept, but several additional cryptocurrencies have also sprung into existence. In fact, there are currently over 10,000 cryptocurrencies, all of which are based on the original Bitcoin network or one of its versions. Additionally, a variety of applications are using blockchain technology, the most important of which is the decentralized finance, or DeFi. Despite the potential of this new form of money, it is important to note that many financial institutions view cryptocurrencies as useless temporary investments, and some claim that neither Bitcoin nor the blockchain have been successful in resolving any societal issues. For instance, critics point out the significant price volatility, massive energy usage, or the considerable amount of time it takes to validate transactions and create liquidity. Although it is still unclear whether cryptocurrencies will succeed in revolutionizing society, they already play a crucial role in finance and have enormous potential. Currently, there are over 43 million active cryptocurrency traders, according to a 2019 survey, and the total market capitalization of cryptocurrencies is around $1,500 billion. Therefore, it should not come as a surprise that numerous research have attempted to study cryptocurrencies from a scientific standpoint utilizing methods from complex systems and network science. For instance, a number of research concentrated on Bitcoin, paying close attention to its network and price prediction or dynamics, whereas very few assessments looked at the cryptocurrency market as a whole and attempted to model its intricate dynamics. The open-source nature of blockchains is one of the key factors influencing the Bitcoin ecosystem. Since all of a cryptocurrency's source code is normally available to the public, it is possible to edit or combine such source codes to produce a new blockchain with a unique coin. By altering the block generation time, the maximum amount of coins, and the hashing algorithm. For example, Litecoin was developed in 2011 starting with the source code of Bitcoin, but the majority of its structure is identical to that of Bitcoin. Similar to how Litecoin's source code served as the foundation for the creation of Dogecoin, Aurora Coin, and many other cryptocurrencies. These procedures are typically referred to as software forks, but a hard fork or blockchain fork might also result in the creation of a new coin. When some nodes that are part of the blockchain decide not to agree with an update to the rules controlling the blockchain or to accept new rules, this is known as a hard fork. As a result, the blockchain splits and a new coin is created. Examples include Bitcoin Cash, which was created in 2017 from the Bitcoin blockchain, and Ethereum Classic, which was created in 2016 as a result of a hard fork in the Ethereum blockchain. Last but not least, It is possible to manufacture new cryptocurrencies by copying portions of the source code of coins that are already in existence. The cryptocurrency market has grown significantly since the launch of Bitcoin in 2009, both in terms of the overall market worth and the variety of cryptocurrencies. Innovation has been one of the main engines behind this expansion, as all blockchain and cryptocurrency source code is normally available to the public and may thus be reused and combined to produce new cryptocoins. The cryptocurrency market has been defined by a few consistent statistical patterns throughout this process, one of which being Zipf's law. Starting from this, we demonstrated two potential regimes in which the cryptocurrency market could exist, depending on the magnitude of Zipf's exponent. In contrast, if Zipf's exponent is more than 1, as seen in real data, the dominance is asymptotically greater than 0. If Zipf's exponent is smaller than 1, the dominance, or market share, of the largest cryptocurrency asymptotically decreases to 0. This study also enabled us to calculate Bitcoin's anticipated asymptotic dominance, which we predict will continue to fluctuate around the figure of 0.5. Furthermore, we demonstrated that Heaps' law, a statistical principle frequently observed in open expanding systems marked by novelties and innovation, may be used to explain the expansion of the Bitcoin ecosystem. This law suggests that the number of unique cryptocurrencies increases as a sub-linear power of the overall market cap in the case of cryptocurrencies, demonstrating the inherent relationship between these two numbers. Finally, based on preference attachment and the idea of adjacent possibility, we created a model to explain the innovation process in the Bitcoin ecosystem. The model replicates both Heaps and Zipf's laws as well as the existence of two distinct regimes depending on the number of new Bitcoin creations, or depending on the size of the adjacent possible. In particular, an adjacent possible smaller than 2 corresponds to the regime where the greatest crypto's dominance is bigger than 0. More specifically, the model predicts this number to be 1.58, and after investigating the Bitcoin forking tree, we discovered that in this particular instance, the average size of the neighboring possibility is 1.59. However, forging the agreement, we emphasize that our model still has significant limitations. In fact, even though we anticipated that each cryptocurrency would produce the same number of new coins, there are some coins in the forking tree of Bitcoin, such Litecoin and Bitcoin itself, that produce a significant portion of the overall number of coins. Thus, to emulate likewise this element, it would be desirable to take into account a probability distribution for the size of the adjacent possibility. Furthermore, because the data we used to calculate the adjacent possible were restricted to the Bitcoin forking tree and did not include recent years, analyzing data from other forking trees or more recent sources would undoubtedly provide more insight into the innovation process in the cryptocurrency ecosystem. So share your views with us in the comments and subscribe to our channel for more.